Welcome back to Your Money, Your Caller. Joanne from Melbourne. Very good evening to you, Joanne.
Good evening, Nina and Roger and Ilio. I was just wondering, please, what the panel thought of the stock Hasty Group, which is HST code. Thank you.
All right, well, let's take a look at the chart for you, Joanne, see how it's performing. Looks like it's had a bit of a tough year there.
I'll just say this. Ask yourself, when you buy a company, you really want, it's really quite simple. You want a business that is going to sustain very high rates of return on its equity. Now, the only way it can do that is if it's got a competitive advantage. And a competitive advantage is something that makes people cross the road to be a customer of that business instead of a customer of a competitor. So, and the most valuable competitive advantage is a competitive advantage where the company can charge more every year for the same service, essentially, and people keep paying it. So ask yourself, does Hasty have a competitive advantage? Does it have a reason that people go to it over its competitors? And is it able to charge more every year? If that's not the case, then what you probably find is that the return on equity is going to be mediocre at best, so it's going to be, you know, maybe 10% or 15%, but it won't be the sort of 45% that I like and that you see in companies like JB Hi-Fi and Cochlear and the like. So I just tend to avoid these sorts of businesses.
Let's go to John from South Australia. Hi, John.
Hi, Nina, how are you?
Hi, really well. Thanks for calling in tonight.
Thank you. I'm wondering if the boys could give me their opinion on a company called Data3, code DTL.
Yeah.
All right. Just below $8 this one's trading at. Roger?
I was... this happens every time. There's always a company, and I don't know if this bloke's asked me... sorry, what's his name?
John from South Australia.
John, have you sent me an email and asked me for this company as well?
No.
Oh, OK. It must be about 35 other people.
Actually, before we go to our next caller, I wanted to take you to an email that we've received from Joe, who has held shares in Atlas Iron, which is stock code AGO, since January 2008. Real roller coaster, because look at this. He bought in at $1.70, saw it rise to $4.37 pre-GFC, then plummet down to 40 cents, and now claw its way back to $2.40. And would like to know what your thoughts are on this particular stock. That's Joe writing in on Atlas Iron.
The issue with the question is that it's replete with references to price. There's nothing about the value of the company there. I bought it at $1 and it went to 4 and then it fell to 50 cents and now it's at 2. Well, that's what prices do, you know, but they're not necessarily reflecting the value of the business. There's a whole bunch of issues around iron ore. You know, you've got Rio and BHP saying that, you know, they're going to see a 90% increase in iron ore prices being negotiated this year. Then you've got people like Jim Chanos over in, you know, the biggest short fund in the world, the short hedge fund. He's out there saying there's a property bubble in China and the whole thing's going to collapse. So look, you know, hey, flip a coin, and that's why you've got to come back to value, and you've got to only buy businesses below their value. If they rise significantly above, then that's an opportunity to sell. Without a reference to value, what this particular emailer has written is going to happen to everyone.
OK. Joe, thanks so much for emailing in. I hope you've been interested in what my panellists have to say. We're going to go to our next caller. It's Kathy, who's been waiting patiently. She's from Melbourne. Hi, Kathy.
Hi, good evening, panel.
Good evening to you.
I'm thinking of buying into Navigator, which is NAV. They own a project in Western Australia, which is for gold, and they're just about to commence production in April 2010, and I'd like to know what the panel thinks of it.
OK. Currently about 16 cents, and we'll get the chart. There we go. Navigator Resources we're talking about. Roger? OK,
well, the issue with all of these companies is, you know, they're going to go into production. I've heard that a couple of times. Don't know if you have, Elio, but yeah, I've heard that before. Hopefully they do. Once they do, what price are they going to get for their gold? Are they going to hedge their production or not? And then you can work out a return on equity and work out the value of the business. But until they actually produce something, it's very, very hard to value. It's a strange thing, gold, Nina. You know, we dig it out of the ground, we look at it, and we put it back underground again. And it has no intrinsic value at all other than the value we attribute to it.
I'll take it off your hands if you want.
Exactly. And so forecasting the price is very, very difficult. And so valuing these sorts of businesses becomes even more difficult.
We're going to go to the National Capital now and have a chat with Michael. Good evening, Michael.
Good evening, panel. Thank you for taking my call. Look, I was wondering if I could get some judgment on River City Motorway, which is RCY is the code. And the information I'm after is if the panel could tell me how many cars going through the tunnel will make it a profitable tunnel.
Oh, I don't think my panellists would have that information at their fingertips, I'm sorry.
All I know is that... Well, to be serious, all I know is that the number of cars travelling through the tunnel is actually exceeding expectations.
Okay, so they're doing better than the Lane Cove Tunnel and the Cross City Tunnel in Sydney?
That's what I read, yeah, a lot better than the Lane Cove Tunnel. Having said that, if that's right, then the reaction from the share, the share price is odd. Maybe the market had greater expectations for the traffic than even those estimates. So look, difficult to value, too early in its life to actually know what it's going to be like as a mature asset. And it just brings me to a comment about these roads generally. If we're at a dinner party and I was asked the question, what do you do for a living, Rog? And truth be known, right now, not much. But if I was asked the question and my answer was I own the M2 or I own the Cross City Tunnel or whatever it was, most jaws would drop. But if I said to you, I get $200 million revenue a year out of that, and out of that $200 million, I pay about $300 million in interest on the debt that I've got, well, no one would really, it wouldn't be that much of a jaw-dropping experience. So don't focus on the asset as much as the structure that the asset is in. If you focus on the structure of the asset, you'll get a sense of what it is you actually own. And so that's what I'd recommend here. Could we just talk about Transurban for a second?
Yes, absolutely.
Let me just tell you, because this is an interesting... This idea about roads and infrastructure assets and talking about pension funds, and it raises for me a very interesting dilemma. Many of these roads have to be handed back to the government debt-free, so they're part of public-private partnerships, and they eventually have to be handed back without any debt involved. What I haven't been able to work out, and I was on one of your competitor networks owned by the government, I should say, talking about Macquarie Infrastructure Group many years ago and saying that the model was unsustainable, and indeed it was. And what the problem is, I don't think you can match the cash flows. I don't think you can grow the distributions and continue to pay out those distributions while you're paying out greater debt to fund distributions that exceed revenue. And if you're trying to do that, and I don't think that's the case in this particular example, but if you try and do that, it's an unsustainable model. And whether it's owned by us or the pension funds, it's not going to end up a happy story. Let me say this, silly people live in all different countries, not just in Australia. And that means that they pay silly prices for assets, even if they're an overseas pension fund. I think in Australia we have a symptom of being distant and young as a nation. And so we think when the Singaporean Wealth Fund buys into ABC learning centres at $7.40, they're smart. We think when a Canadian pension fund is buying an asset in Australia, they know something we don't. Silly people live in all different countries and silly prices are paid for assets all over the world. It's not unique to Australia.